When most of us hear the word accounting, our minds probably jump to, I don't know, historical record keeping.
Right.
The dutiful recording of money that was spent 6 months ago.
Hmm.
Maybe a little dry, maybe a little dusty.
And that dated view is exactly the crucial misconception we really need to dismantle today.
Because what we're exploring in this deep dive is that accounting isn't just a backward-looking ledger. It's the living, breathing, central nervous system of a modern business.
It's the language of value.
And critically, it's the foundation upon which all economic trust is built.
If you step back for a moment, the entire structure we're about to map, it all exists to solve a really fundamental challenge, one that underpins, well, all of commerce.
Which is?
The problem of trust between strangers. If I'm an investor or a bank and I don't know you, why should I trust your company with my money?
Okay, right.
Reliable, standardized accounting, it dramatically reduces the uncertainty in that transaction.
And that reduction in uncertainty is really the superpower of this whole system because it translates directly into economic efficiency.
It does.
When investors trust your numbers, your company can get capital loans, investments at a much lower rate. So the mission of this deep dive is to give you that mental map, the quick, thorough shortcut to understanding this entire financial ecosystem.
We're going to look at the rule makers, the enforcers, and some of the revolutionary forces that are changing the whole game.
So let's start with the key players. If we think of business as this high-stakes, global game, we need to know who's writing the rule book.
And who's refereeing the play?
And who is the ultimate enforcer.
Well, we have to begin with the rule makers. In the U.S., the primary rule setter is the FASB, the Financial Accounting Standards Board.
Okay, FASB.
They're the ones who write U.S. GAAP, that's generally accepted accounting principles.
And their global counterpart is the IASB, the International Accounting Standards Board, which sets IFRS, used in well over 140 countries.
That's right.
And these groups don't just differ in their zip code, Norwalk, Connecticut versus London. They have a fundamentally different philosophy, don't they?
They absolutely do. And this is the key insight beyond just memorizing the acronyms. U.S. GAAP from the FASB is traditionally a rules-based system.
What does that mean exactly? Rules-based?
It's very specific. It says if X happens, you must do Y. The whole goal is to reduce ambiguity and legal interpretation.
Whereas the IASB's IFRS is what?
IFRS is largely a principles-based system.
Yeah.
So it sets these broad concepts like a company must reflect its substance over its form, and then it gives management more professional judgment in how to apply those ideas.
That's a huge difference. That's how much wiggle room you have when you're measuring your own performance.
It is. It's a massive difference.
Okay, so once the rules are written, we need the people who actually implement and verify them. And that brings us to the AICPA.
The American Institute of Certified Public Accountants. You can think of them as the referee, the trainer, and the certifier all rolled into one.
So what's their role?
The AICPA is central to the whole profession. They run the uniform CPA exam that you have to pass to get licensed. They set the code of professional conduct.
And crucial.
And critically, they make sure that only CPAs, people who meet these high standards, can actually sign an official audit report.
Got it. And that brings us to the highest authority, the ultimate enforcer, the SEC.
The Securities and Exchange Commission. The SEC is the government agency created after the Great Depression with the final legal authority to set accounting standards for public companies.
So they have the final say, even over the FASB.
Yes. While the FASB writes the day-to-day technical details, the SEC has the power to oversee the FASB, demand changes, investigate, and levy serious fines.
So the FASB is the specialist, but the SEC is the one holding the hammer.
That's a perfect way to put it.
Now, understanding why there's so much regulation, why we have all these layers, you really have to understand the history behind it.
Exactly. The strict environment we have today is a direct historical response to crisis. A massive crisis.
We are, of course, talking about the fallout from Enron and WorldCom back in 2002. It's hard to overstate just how bad that was.
It was catastrophic for the markets. Those frauds created a total crisis of confidence. They wiped out an estimated $2 trillion in investor wealth.
$2 trillion?
Public trust in financial reporting was just shattered. Congress had to act, and they acted decisively. They passed the Sarbanes-Oxley Act, or SOX.
And SOX wasn't just window dressing. I mean, it was a sledgehammer that fundamentally redefined risk and accountability for every single manager.
It did.
So what are the key things a manager today really needs to understand about the legacy of SOX?
The first, and maybe the most significant, is just increased management accountability. Before SOX, management could sort of claim ignorance of fraud happening lower down the chain.
Right. Plausible deniability.
Not anymore. Now CEOs and CFOs must personally sign and certify the financial reports. They are legally attesting to their accuracy.
Which dramatically raises the stakes. You're putting your personal reputation, your liberty on the line.
Absolutely. The second big change was the creation of the PCAOB.
The Public Company Accounting Oversight Board.
Right. Which is often pronounced peekaboo, but its role is deadly serious. It's the specialized inspector, the watchdog for the watchdogs.
So why did we need a new organization for that? I mean, wasn't the AICPA already setting auditing standards? Weren't they supposed to be auditing the auditors?
That's a critical question. And the consensus after Enron was that the profession had failed to self-regulate.
Oh.
The crisis exposed this huge conflict of interest, where audit firms were just too dependent on consulting fees from the very clients they were supposed to be auditing.
Okay, so SOX fixed that.
It did. It stripped the AICPA of the power to set auditing standards for public companies and handed it to the new government-supervised PCAOB. The PCAOB now inspects the Big Four, investigates misconduct, and disciplines them.
It made sure the auditors answered to the public, not just their clients.
Exactly. And the third major piece is Section 404, which is the one that lands right on the desk of every department manager.
Not just the finance people.
No, everyone. Section 404 is all about internal controls. It requires management to report annually on how effective the company's internal controls are, and then the external auditors have to attest to that.
So what does that mean in practice for, say, a marketing manager or an operations manager?
It means that the specific processes you use every day, how you authorize a purchase, how data is backed up, how assets are safeguarded, all of that has to be formally documented, tested, and audited every year.
So you personally are a key link in the chain, ensuring that the data that eventually hits the financial statements is reliable.
You absolutely are.
All right, let's tackle a major source of confusion, maybe even suspicion for some people. The idea that companies keep two separate sets of books.
Right.
To an outsider, that just sounds shady. But it's standard, it's legal practice. So why? Why do we need two different accounting systems?
Because they serve two completely different masters with two completely opposing goals. It's a necessary divergence.
Okay, let's define those goals. First, financial accounting.
Financial accounting, governed by FASB and GAAP, its main goal is to provide information that is most useful to investors and lenders. Its aim is to reflect the company's economic reality.
How much wealth was truly generated?
Exactly. And tax accounting, governed by the IRS.
A different master entirely.
Its goal is purely statutory, to efficiently collect government revenue in a fair, consistent, and legally enforceable way. The IRS is not trying to guess your subjective economic value.
They just want to know when they can claim revenue under the law.
That's it. And this leads to very different underlying principles.
Right.
Financial accounting relies on the accrual principle. We recognize revenue when it's earned, no matter when the cash actually moves.
To try and get at your true worth.
Yes. Tax accounting, on the other hand, leans much closer to the cash flow principle.
Right.
It often prioritizes when the cash is actually received because that gives the IRS legal certainty for tax collection.
Let's make this real. Let's use that 3-year service contract example. Your company sells a 3-year contract for $30,000, and the customer pays all of it upfront today.
Okay. So under financial accounting, GAAP, you've only earned 1/3 of that revenue this year, so you had to defer the other $20,000.
And you report $10,000 in revenue each year for 3 years.
Right. You're matching the revenue to the service you actually performed. It's an accurate picture.
But the IRS is focused on something else.
The IRS is focused on when they can claim the tax. So for tax purposes, they may require you to recognize the entire $30,000 as taxable income in the year you receive the cash.
Because that's when the money is actually there.
Exactly. It provides certainty for collection. So that single transaction forces a divergence. The profit you report to shareholders is not the same as the taxable income you report to the government.
And it's not manipulation.
No, it's just compliance with two separate, valid legal frameworks.
Now, if you're looking at an acquisition or a competitor overseas, you are almost certainly looking at reports prepared using that other language we mentioned.
IFRS.
Right. This need to compare apples to oranges is why the FASB and the IASB have been pursuing this long-term project of convergence.
Convergence is the attempt to reduce the differences between U.S. GAAP and IFRS to make global financial statements truly comparable.
The benefits of one single financial language seem so obvious, less work, perfect comparability, but it's been incredibly difficult to achieve. What are the big barriers holding it back?
Well, there are two, really, and the first one is purely political, national sovereignty.
Meaning?
Accounting standards aren't just technical manuals, they're powerful tools of national economic policy. The U.S. Congress, the SEC, they are very reluctant to hand over control of the American economic rulebook to an international body based in London.
It's an issue of pride and control.
It is. And the second hurdle is about policing the rules. A rule that can't be enforced is, well, globally irrelevant.
And that's the enforcement gap.
Exactly. We have the SEC to enforce GAAP here in the U.S., but there's no global equivalent. There's no international SEC with the power to compel compliance or fine firms around the world.
So without that consistent enforcement, any single standard would just fracture.
It would. So the goal of pure harmonization, it seems impossible, and that leads to this ingenious political compromise that the global financial world is kind of working towards now.
The idea of condorsement.
It's a great name for it.
Yeah, it's a blend of convergence and endorsement.
Precisely. The IASB sets the high-quality, technically consistent rules. That's the convergence part. But then each individual nation keeps its sovereignty by officially endorsing those rules for use within its own borders.
And then they use their own regulators, like the SEC, to enforce them locally.
Exactly.
But hold on, doesn't that leave the door open for countries to add their own little exceptions or carve-outs during that endorsement process, which kind of defeats the whole purpose of comparability?
It absolutely does. That is the inherent political trade-off. Condorsement is not perfect, but it's probably the strongest compromise possible that satisfies the political need for sovereignty while still moving the world much closer to consistency.
It recognizes that if you want enforcement, you have to use national power.
You do.
Let's pivot back to the core output of this entire system, the financial statements themselves. These are the tools that fuel that whole virtuous cycle of trust and capital.
And the three primary statements are essential because they each tell a different part of the company's financial story. You really do need all three to trust what you're seeing.
So let's cut through the jargon. Number one, the balance sheet.
The balance sheet is the snapshot. It reports the company's financial position at a specific instant in time.
Like a photo taken at midnight on December 31st.
Perfect analogy. It tells you what the company owns assets and who has claims on those assets, liabilities, and equity. It's that core equation, assets, liabilities, plus equity.
Okay, number two, the income statement.
The income statement is the movie. It reports financial performance over a defined period, a quarter or a year.
So it shows the action.
Yes. The equation is simple. Revenues minus expenses equals net income, or profit. It tells you if you actually generated wealth during that period.
And the third, the statement of cash flows.
This is the cash check. It details where actual cash came from and where it went during that same period. It's categorized into cash from operating, investing, and financing activities.
So why do we need the cash check if we already have the income statement movie?
Because a company can be highly profitable on paper on its income statement, but still go bankrupt.
How?
Well, if all their sales are on credit and nobody pays them, the company's profitable, but it runs out of actual cash to pay salaries and rent. The cash flow statement provides that critical reality check that prevents this illusion of profitability.
So investors and lenders, they require all three because they all link together. The net income from the movie flows into the equity section of the snapshot. And that reliable, integrated set of reports is exactly why your company gets a lower borrowing cost.
Because the lender trusts the whole story.
Now, all of these structures we've talked about, regulation, globalization, are being amplified by technology. Technology is quickly changing accounting from that static, historical record
Into a dynamic, real-time intelligence system.
What's the biggest shift there?
The most immediate one comes from machine-readable data, specifically something called XBRL.
Extensible business reporting language.
That's the one. For years, financial statements were just static PDF documents. If you wanted to compare data, you had to manually copy and paste numbers out of the footnotes.
Huge pain.
A huge pain. XBRL changed all that by assigning a standardized digital tag, like a unique barcode, to every single data point.
From total revenue all the way down to the tiniest detail.
All the way down. And now all public companies in the U.S. have to file their reports using these tags.
So what's the immediate impact for a manager who needs to analyze their competitors?
It enables powerful instant data analytics. You don't read the report anymore, you query the data. You can poll and compare, say, the cost of goods sold across hundreds of competitors in seconds.
It makes financial data radically more transparent.
And more valuable.
This technology, though, raises a fascinating and I think a cutting-edge strategic dilemma: real-time reporting. I mean, theoretically, every transaction your company processes could be reported instantly. We could literally see a retailer's sales updating live on an investor dashboard.
And this is where the tension becomes immense.
Uh,
On one side, you have investors who want maximum immediate transparency.
of course.
But on the other, the company risks massive competitive harm. If your competitor can see the instant impact of your new product launch, they can adjust their own strategy immediately.
So it's a conflict between transparency and protecting your proprietary tactical information.
Exactly. And the current regulatory environment absolutely does not allow outsiders access to a company's internal data feeds. Maintaining that balance, providing the financial overview needed for trust while protecting your competitive advantage, that is the new high-stakes dilemma for management.
So where does this leave the manager listening to this?
The core takeaway is this. You, the manager, you're not just a distant user of these reports. You are the indispensable source of the operational data that feeds this entire ecosystem.
Right.
The ethical decisions you make, the accuracy you apply in your role, all of that feeds directly into the credibility that allows your company to secure its future.
And the forces of change are pushing accounting far beyond just pure financial numbers now. I mean, our sources all highlight this massive, undeniable trend: the rise of non-financial reporting.
If accounting is the authoritative language of value, then that language is rapidly expanding its vocabulary.
In addition to tracking profit and cash flow, the market is increasingly demanding that companies rigorously report on ESG factors.
Environmental, social, and governance. We're talking about quantifiable data on carbon emissions, water consumption, human capital metrics, diversity stats.
All of it.
As a manager, your future role will inevitably involve tracking, auditing, and reporting these detailed sustainability metrics with the same rigor we currently apply to financial data.
So the final question for you to explore is this: if accounting is the foundation of economic trust, is its job now expanding to reliably measure a company's global impact, not just its shareholder profit?
That is the next great frontier for anyone who needs to make informed decisions.